For more on the jobs report specifically, let's add to the conversation Apollo Global Management Chief Economist Torsten Slok as well. And Torsten, do you want to get your thoughts on what we saw in that jobs report? You're the first person that came on CNBC and said there's a divergence between soft data and hard data until the hard data catches up. The soft data is concerning, but it doesn't mean we're tipping into recession. How do you see it now coming off of a jobs report that was better than expected, but still shows signs of softening in the labor market?
You're right, Morgan. And that's exactly the backdrop here, namely that we had, of course, a very turbulent period in April. And that's why it was very significant relief today that the jobs numbers were actually still relatively decent. It is still a downward trend, as Mike just was saying. And we are having a little bit of a worry in the market, of course, with wage inflation moving higher. But the big picture really here is that the market has been trying to assess what is the magnitude of this shock that the trade war was. It was obviously not a shock that had the magnitude of COVID or of Lehman. And the magnitude of the shock was, of course, at least up to this point, so mild that it hasn't quite yet been weighing on the hard data. But Morgan, to your question, we should expect in the market that in particular over the next several months, now companies are adjusting to these high levels of tariffs. It will weigh more and more on earnings. In particular, we just heard Walmart say also about this today that they were continuously worried about the negative effects. So taking together both the trade war still being an impact on earnings over the next several months and quarters ahead, and at the same time also the continued move high in rates, there's still plenty of things to worry about when it comes to the headwinds to the economy.
Torsten, how much do these numbers, you think, reflect what's actually happening now, given the pull-ins that we've had from the various reactions to the Trump administration policy, and also given the expectations on the implications of some of that perhaps inventory build for the second half?
Yeah, that's a very important point, because it does, of course, take time to slow the economy down. And what really is going on is that companies are trying to figure out how should we respond to this level of tariffs. Of course, there's discussion about will these tariffs be permanent? Are they temporary? How long time should we expect them to be in place? But at the moment, if they do stay at these levels, we should expect to see companies, in particular, of course, in the sectors that are vulnerable to trade, continuously adjust. And that adjustment, that's been recognized also by both Scott Bessent and, of course, and Trump, even Navarro, that there is an adjustment period. And we should not expect that that will just be a few weeks or a few months. It's something that is going to take time. So this is still a headwind when it comes to the earnings outlook for the S&P and to GDP. The Yale Budget Lab is predicting that the drag on GDP growth from the trade war will be minus 0.7. So that's not a recession, but it's still enough of a drag to put some upward pressure on the unemployment rate for the next several months. So to your question, we should still expect to see going forward, especially combined with rates moving high in the long end, that there is still a lot of challenges for the economy, not enough to generate a recession, but definitely enough to give it some significant headwinds.